Welcome back. In today's video, I'll be covering the top most bought stocks by your super investors this quarter. So for reference, as usual, this is my portfolio. I'll be updating along the way as well. As for the first stock that is the most bought stock by your super investors, it is none other than United Health. So United Health on Friday was up around 12% after Warren Buffett initiated a position into this stock. The stock is currently trading at a 13 times earnings, around a 17 times forward earnings. So for United Health, a lot of your super investors, they've actually initiated a position in this stock. So you saw David Tepper putting in around 11% of his entire portfolio into United Health. You have Michael Burry at 11%. You have many other funds buying into the company as well. And most importantly, Warren Buffett actually initiated a position into this stock, and he likely added a lot more when the stock was a lot lower post earnings itself. So for United Health, why exactly did the stock sell off? The stock sold off because of higher medical costs which drove down its profits due to the fraud claims, as well as the CEO which resigned. So the ex-CEO, Andrew Whitty, he actually resigned after all the different events came up and piled up together. The entire insurance space is facing headwinds now, and that's why you're seeing all the healthcare insurance companies facing setbacks, which is why the companies are trading down this year. So for United Health, as well as all the other healthcare insurance companies, they will have price hikes next year. So what they will be doing next year is they'll be increasing the prices of all the different insurance plans that they have. So all your insurance plans, they are short tail insurance, meaning to say the coverage period is a very short amount of time, and they can easily hike prices like what they'll be doing next year. So a lot of your healthcare insurance companies, they're increasing prices by upwards of 15% next year, which will help to improve margins for all these companies. So besides that, United Health also brought back their veteran CEO, which is Hemsley. So Hemsley actually guided United Health through a lot of different periods of time. So he brought the company through your 2008 crisis, he brought the company through your ACA healthcare changes, and he basically transformed United Health into a vertically integrated business. So his return is definitely an important one to turn around United Healthcare. So for United Healthcare's valuation today, the company is trading at a 13 times of earnings and around a 17 times forward earnings. So for the company today, it is still drastically below its historical averages. And once this year is over, you can expect growth to resume next year, which is what the management have previously said as well. The next stock that I'll be covering is Amazon. So Amazon year to date is up around 5%. A lot of your super investors, they actually bought into Amazon around the April period, where Amazon, as well as all the other S&P 500 companies, were crashing because of your tariff news. So the stock sold off because of your tariff news. So you had your China tariffs, you had tariffs on all the other different countries, which could have hurt Amazon's profitability because Amazon sources a lot of its products elsewhere, and Amazon also has a lot of third-party sellers from China, for example. So that was why the stock sold off, and all these super investors, they actually added into Amazon. So for Amazon, the company has been spending a lot of money on infrastructure. So one of the possible theses is that Amazon will gradually slow down the spending on all this physical infrastructure, and this will help to improve the profitability and the margins of the company. And besides that, your big beautiful bill will also spur consumption in the US, which will help to drive up the retail sales number and help to drive the retail portion of Amazon's business. So besides their AWS, besides their wonderful subscription, as well as advertising businesses, the retail side is one that is underestimated by Wall Street, and this could be the one that will drive up the earnings for Amazon if we see some form of margin expansion. And besides that, Amazon also has this optionality with robots. So the company is probably the biggest robot company in the entire world right now. And this optionality will allow it to raise its margins by a very large extent over the next few years if they're able to implement them into its warehouses as well as its distribution centers. So for Amazon today, you're buying a company that is trading at a historical low valuation. The company is currently trading at a 35 times earnings. I think Amazon today is around fair value. The company was cheap at around $170, $180 a share. And for now, Amazon is a decent long-term hold company, and the company is trading at fair value. The next company that I'll be covering is Pinduoduo. So Pinduoduo is a surprising one. The stock is up around 22% year to date, currently trading at a 12 times of earnings. So Pinduoduo was actually added by a lot of your different super investors, and one that I follow is Lilu. So Lilu, he actually added around 18% of his entire US portfolio into Pinduoduo, which is quite interesting. So for Pinduoduo, the stock sold off during April because of the tariff news, and besides that, they also reported terrible earnings. So poor earnings from the company, the net income dropped, the growth decelerated as well. So you saw revenue growth of only around 10%. We saw operating profits decreasing by 38%, net income dropping by around 47% year on year. So that was a terrible quarter for Pinduoduo, and despite that, Lilu actually bought into the company. So here are some of the possible theses for Pinduoduo. So the first one is that the company is shifting away from low quality products or maintaining low prices. So for Pinduoduo, they have a lot of logistical, they have supply chain advantage over its competitors like JD as well as Taobao. So they have the ability to source for low cost products, and what the company is trying to do right now is to shift away from low quality products so that they can move away from the brand image of them being a low quality company. And besides that, the company is also actively trying to increase its average revenue per user. So if you were to compare Taobao and JD's average revenue per user, it is substantially higher as compared to Pinduoduo. So what Pinduoduo is trying to do right now is to lock in all their customers by providing more incentives, thereby increasing their average revenue per user. But there are a few things to consider with Pinduoduo, which is why I don't think it is a very good investment. So what the company is trying to do right now is basically try to gain more market share. So what they've been doing is to increase their advertising, their sales and marketing and so on. And that has drove down the margins of the company. And the problem with this is it will hurt profitability. And if competitors do the same as well, then it's sort of like a price war where no one wins. So that's why for all these retail companies, especially for the ones in China, they are generally avoids because what they do best is they drive down prices. And when they drive down prices, they will hurt their own margins, which is not great overall. So that's why I continue to avoid all these Chinese retail companies, although they're trading at very good valuations. So for example, Pinduoduo is trading at a 12 times of earnings. If you're to net out their cash, they're actually trading at a single digit PE ratio. Although it's extremely cheap, I don't think it is a high quality business. And that's why I don't think this stock is in my consideration anytime soon. The next stock that I'll be covering is an interesting one as well. This company is Lululemon. So Lululemon year to date is down around 46%, similar to United Health. It is currently trading at a 13 times of earnings. So for Lululemon, you saw Michael Burry buying 21% of his entire portfolio into Lululemon. So for Michael Burry, his investment style is a bit different from all the other super investors. He's an investor that switches his stocks almost every single quarter, and he clearly sees value in Lululemon today, and that's why he added into this stock. So for Lululemon, the stock sold off because of a poor earnings quarter. So the company saw slowing revenue growth, and slowing revenue growth is typically the first indicator of a slowing business, a maturing business, which is what Lululemon is becoming today. But here are some possible theses for the company. The first one is that Lululemon offers premium products. So their consumer demographic are those that are highly affluent. So over here, as you can see, Lululemon's customer profile is affluent women and men who are career driven, yet at the same time making life healthy and fitness a top priority. They are high earners and can afford the uncompromising blend of comfort, quality and style that Lululemon provides. So Lululemon targets the rich people, and that's why they're able to increase their prices. And that is one of the theses with the company. So if you were to look at the margins of the company, this is the gross margins. Gross margins has been increasing almost every single quarter since around 2016, and I expect the company to be able to do so as well. Besides that, for Lululemon, they're actively trying to increase their international portion of the business. So although currently around 70% is made out of US today, they're trying to increase the other 30%, which is growing rapidly. So if they can substantially grow the other 30%, this could be another growth driver for Lululemon the years ahead. So for Lululemon, the company is trading at a historical low valuation. So the company has never traded at below 13 times of earnings and currently is trading at that valuation. So for Lululemon, it is not pricing in a lot. I mean, at 13 times of earnings, you're pricing in around 6% growth, which is definitely possible. I mean, they raised the prices by 22% in a single year. So for Lululemon today, I think it is a company that is cheap, although it will be one that I'll be avoiding today. Last portion, I'll be covering some questions left in the comments. So the first one, it says, what's your thoughts on Oscar Health? So Oscar Health is a company that provides insurance in your ACA healthcare space. So it's more of privatized insurance. But for me, I think in the healthcare insurance space, simply buying the biggest juggernaut when the entire sector is down is probably the most predictable way to get returns when the sector is depressed. And that's why I own United Health and not Oscar Health. And besides that, Oscar Health is also very retail driven. So a lot of your retail investors are actually speculating on the stock and they're piling into this stock. And when you see a downturn, you will not only see the normal sector decline, you will also see added declines because of retail piling into this stock. And that's why I probably won't touch Oscar Health. It is a company that is probably a bit too speculative. I think United Health is the more predictable bet in this space. The next comment it says, success in trading is not predicted on stock picking. It is predicated on exiting a trade properly within risk tolerance. Doesn't seem like anyone wants success now or 25 years ago. They just want to know what stock to buy, such rubbish, and who cares what is on another guy's watch list? Your system is not his system. This is so stupid, it is beyond comprehension. But amateurs and wannabes just want to follow. They follow until they have to go back to work. Just look at these idiots commenting, asking if their stocks are good or bad, or what's your opinion on this stock. The reality is that 95% of you are going to lose money. Less than 5% will do what is required to trade and invest for a living. Then you follow some Asian dude who operates from his bedroom. What could be worse? Okay, my bedroom is terrible, and yes, I'm Asian. I can't say I disagree with this. I mean, Wall Street is quite evil. Wall Street is terrible. Wall Street is probably a lot more evil than what a lot of investors think. The problem with social media is that people glorify, and there's a lot of survivorship bias as well, which leads people to think that, oh, the stock market is a place where you can make money for sure. But I don't think that's the case. As for his comment earlier up there, I'm not planning to comment on it. I hope you guys have found this one useful and invest.